Hello everyone, welcome to today's US Open live webinar. It is December 5th, Tuesday, 10 minutes before Wall Street opens. As always, I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. We have quite a few things to talk about, starting off with Saudi Arabia and Russia and other OPEC Plus members, which slashed oil output again, but oil prices remain in the doldrums as markets appear to be underwhelmed. Chair Powell late last week spoke and markets viewed it as dovish, bolstering rate cut optimism, while today influential ECB policymaker hinted at peak rates after the inflation deceleration that we've seen in recent data, while the Central Bank of Australia delivered a dovish hold and the Aussie slides. These are some of the main things we'll be covering today, but as always, please read carefully through the risk warnings and the disclaimers before we begin. Once again, please go over the risk warnings and the disclaimers and bear in mind that anything discussed in this session does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. We're gonna start as usual with Euro USD and talk about the expectations around the central banks. Then we're going to cover the dovish hold by the Reserve Bank of Australia, which weighs on the Aussie. We're gonna then pivot to US oil, which falls despite the sizable OPEC plus cuts, and round things off with the Nasdaq and with what's ahead. Now, Euro USD rallied last month, as you can see on the chart, on increasing market optimism that the Fed is done hiking and that it will begin slashing rates. And markets interpreted Chair Powell's speech as dovish, the speech from last week. And CME's Fed Watch tool currently prices in 125 basis points of cuts. That's pretty aggressive, starting in March, so pretty soon. However, the European Central Bank is a better candidate for being the first major central bank to start cutting. And again, this may be overstretched, overestimated this prospect, but still the ECB seems to be in a better position for such an outcome. Why? Because inflation has dropped further or has decelerated more. Preliminary November CPI decelerated to 2.4% year over year, close to the 2% target, while the Fed is still above 3%. Furthermore, the European economy is in a bad shape despite some improvement in recent PMIs, and the German economy is doing even worse and expected to contract this year. The US, on the other hand, is doing great, and the labor market is tight despite coming into better balance. Today, in a Reuters interview, influential and hawk ECB voter Ms. Schnabel spoke of remarkable progress on inflation, and she hinted at peak rates, saying that the latest data have made further rate hikes rather unlikely. Now, Euro USD drops as a result and tests again critical support provided by the 38.2% Fibonacci of the relief rally from the 2023 lows, and the 200-period EMA. Daily closes below this area could send it into the daily Ichimoku cloud, which starts at around 1.07. On the other hand, market opportunities for a Fed pivot can contain the pullback, and as long as this key technical resistance is defended, the pair has the ability to push for higher highs, currently at 1.1017, but we remain cautious around greater advance. In any case, the policy differential is a bit muddy at this stage, as both central banks may have already done enough and could begin to hike over the next few months, but there still need to assess the data, and we have more coming in, and of course this month we expect policy decisions by both central banks. Now let's turn over to the Aussie. The Reserve Bank of Australia had raised rates last month to 12-year highs to be more assured that inflation will return to target in a timely manner, but had made a dovish shift to its rhetoric, now then saying that whether further tightening of monetary policy is required will depend on the data. Today, it returned to a holding stance and maintained, keeping rates unchanged, and maintained this watered down rate outlook, and focusing in on high uncertainty around the data and around the rate outlook. Governor Bullock has hawkish credibility. Inflation is coming down, the labor market eases, and there is a long time until the next decision, which is in early February. As such, officials do have room to assess incoming data starting tomorrow with Q3 GDP, and definitely have room to stay on the sidelines. And markets currently don't expect another hike. On the other hand, the Reserve Bank of Australia does not expect to hit the top of the 2 to 3% target range in inflation for another 2 years. Historically, high wage growth makes controlling inflation harder, and the labor market is still tight despite easing, so more action may be required. Now, today's Dovish holds extends the pullback in AUD USD and creates risk for a breach of the 200-period EMA, the black line that you see on the chart right above the 0.65 handle. Daily close below it would shift bias back to the downside, but strong catalyst would be needed for sustained weakness. Hopes for Fed cuts can help the pair, and as long as it stays above the 200-period EMA, bulls are still in control. As such, we can see an effort to reclaim those highs from the start of the month at around 06691, but does not inspire confidence for much more at this stage. Again, here the policy differential is a bit murky. Now let's shift gears and talk about oil prices. Saudi Arabia, Russia, and other OPEC Plus members agreed to voluntarily cut supply by 2.2 million barrels per day for the first quarter of the next year. These are on top of existing caps of around 3.3 million barrels per day for the duration of 2024. Markets reacted negatively, probably thinking that OPEC Plus may not have more cards to play in order to support oil prices if they continue to fall. And furthermore, the last decision, as we said, was voluntary and did not extend to all members. And there are also concerns already around compliance on the existing program as well. Moreover, demand growth is set to slow next year, according to the latest report by the International Energy Agency, while non-OPEC countries are expected to drive global supply growth. US oil runs its 7th straight losing week in the worst streak in 5 years. It is in risk of sub 70 moves, although the 2023 lows are distant at this stage. It's the support at the bottom of the screen at 63.63. On the other hand, total supply cuts are sizable and could prevent the surplus of which the International Energy Agency had warned. Meanwhile, hopes for rate cuts by major central banks and the continuation of the Hamas-Israel war can provide support. US oil already catches a breath today, and we could see a rebound, but meaningful recovery above the 200-period DMA at around 78.70 looks hard, and the upside remains hostile, as we have talked. Again, you can see key hurdles following the 200-period EMA. With the US session already underway, let's talk about the NASDAQ 100, which rallied hard in November, boosted by Fed optimism, soft landing exuberance, and strong quarterly results by tech giants at the forefront of artificial intelligence. This has brought the index closer to the record highs at 16,770, but we're still unconvinced that it's ready to take them out, although we do believe that this will be the eventual outcome. The Fed may still need to tighten further. We already talked about that, and Chair Powell warned of that last week. And the index actually drops after its multi-month peak, weighed by senior US trade curves. And speaking on CNBC, the US Commerce Secretary said that the threat from China is large and growing, stressing the need for control on exports of advanced artificial intelligence chips, which of course threatens to undermine the AI boom. And from a technical perspective, the index is now exposed to the 200-period EMA at around 15,500, but we're still cautious around sustained weakness past that level, and you can see how we do have some support areas following. Now, we don't have many events over the next couple of days, many crucial ones. At the top of the hour, we expect US PMIs and jobs openings ahead, of course, of Friday's NFPs, but we'll talk more around the NFPs at our next session. Australia Q3 GDP and Bank of Canada policy decisions are due on Wednesday. The BOC held rates at 5% in September after 2 consecutive hikes, but is concerned around inflation and stands ready to hike again if needed. However, inflation eased in October. Unemployment rose to nearly 2-year highs last month, and the economy contracted by 1.1% in Q3. So this could keep them keep policymakers on the sidelines, and these are, of course, the baseline expectations as well. So that's it from me for today. Thank you for joining me. We will talk again on Thursday at our usual time slot, 10 minutes before Wall Street opens.